What if I told you that some of the most powerful players in the global economy aren't Wall Street banks, European investment giants, or Middle Eastern sovereign funds, but Canadian pension funds? That's right. The money that teachers, nurses, construction workers, and ordinary Canadians set aside for retirement has quietly grown into one of the most influential financial forces on the planet. And during some of the biggest economic crises of our time, these funds have done something extraordinary. They've stepped in, invested billions, and rescued companies that otherwise might have collapsed. In other words, Canada's retirees, without even knowing it, have saved parts of the global economy. Sounds unbelievable, right? But once you start digging into the history of Canadian pension funds, you'll see just how real this hidden story is. And before we dive deeper into this world of secret rescues, don't forget to like, comment, share, and subscribe, because this is exactly the kind of hidden global story that deserves to be told. So, let's set the stage. Pension funds are supposed to be simple. You work, you pay in, and when you retire, you get a steady income. That's how it works in many countries. But in Canada, something unusual happened. Instead of keeping all that money tied up in government bonds or small investments, Canadian pension funds transformed themselves into global giants. Today, the biggest ones, like the Canada Pension Plan Investment Board, CPPIB, the Ontario Teachers Pension Plan, OTPP, and the Caisse de dépôt et placement du Québec, CDPQ, control hundreds of billions of dollars each. Together, Canadian pension funds manage well over $2 trillion in assets. That makes them some of the largest investors in the world. And here's the kicker. They don't just invest in Canada. They buy airports in Europe, toll roads in South America, shopping malls in Asia, and office towers in New York. If you look closely, you'll find Canadian pension money in almost every corner of the global economy. But why does this matter in times of crisis? Because when the world economy shakes, most investors panic. Stock markets tumble, banks freeze up, and many companies run out of cash. That's when Canadian pension funds, with their long-term horizons and deep pockets, step in. They're not chasing quick profits. They don't have to answer to shareholders every quarter. Their job is to think decades ahead, making sure retirees can be paid not just this year, but 30 or 40 years from now. That gives them the patience and the courage to make moves when everyone else is running for the exits. Take the global financial crisis of 2008. Banks were collapsing. Stock markets were in free fall. Entire economies seemed on the brink of collapse. Most investors pulled back. But Canadian pension funds, they went shopping. The Ontario Teachers Pension Plan bought stakes in struggling companies. CPPIB poured billions into distressed assets, stocks and bonds that nobody wanted, but which they believed would recover in time. While hedge funds and Wall Street firms were trying to survive day by day, Canadian pensions were quietly scooping up deals that would pay off for decades. In fact, many analysts now say that Canada's funds not only protected Canadian retirees during the crash, but also stabilized parts of the global financial system by providing liquidity when it was needed most. And this wasn't a one-time event. Fast forward to the European debt crisis in the early 2010s. Countries like Greece, Spain, and Portugal were drowning in debt. Investors were terrified that Europe itself might break apart. Once again, Canadian pension funds saw opportunity. CDPQ, for instance, invested heavily in European infrastructure at a time when local investors were too scared. They bought toll roads, airports, and utilities, assets that were struggling because of the crisis but still essential in the long run. By stepping in, they not only rescued companies from collapse, but also reassured markets that long-term investors still had faith in Europe's recovery. Then came the COVID-19 pandemic. Businesses shut down overnight. Airlines were grounded. Shopping malls sat empty. Oil prices even went negative for a brief moment. Around the world, companies begged for lifelines. And there again were Canada's pension funds, quietly injecting billions into global companies. CPPIB invested in tech and logistics firms that would thrive in a digital-first world. OTPP supported companies in transportation and real estate, betting that people would eventually return. These moves didn't just protect Canadian retirement savings. They helped keep vital companies alive during a moment of unprecedented crisis. But how did Canadian pension funds become so powerful in the first place? The answer lies in what's often called the Canadian model, of pension management. Unlike many countries where pensions are managed by government departments or small agencies, Canada professionalized the system. The big funds are run like top-tier investment firms, hiring some of the best financial talent in the world. They're independent from day-to-day politics, which means governments can't raid them to cover short-term budget gaps. And they're allowed to invest globally, across every asset class, from stocks and bonds to real estate, infrastructure, and private equity. The result? Canadian funds consistently punch above their weight, earning strong returns while taking on the kind of long-term projects that others shy away from. Let's zoom in on one example, the Ontario Teachers' Pension Plan. Back in the 1990s, OTPP was one of the first big funds to embrace private equity, buying whole companies instead of just stocks. Over the years, it built a reputation as one of the smartest, most disciplined investors in the world. During the 2008 crash, while others were panicking, OTPP bought stakes in airports and utilities. During COVID, it invested in technology companies and logistics networks. In both cases, those bets paid off. Teachers in Ontario probably don't think of themselves as global financiers, but in reality, their retirement money was helping to stabilize the world economy. Another example is CPPIB, which manages the savings of millions of Canadians. With assets now over $600 billion, it's one of the largest investors on Earth. CPPIB has a mandate to think long-term, which means it can afford to make bold moves during crises. In 2009, when markets were still shaky, CPPIB invested billions in US real estate and European companies. 10 years later, those investments had doubled or tripled in value. During the pandemic, CPPIB again went on the offensive, investing in renewable energy projects, tech firms, and healthcare companies. In some cases, its investments gave struggling companies the capital they needed to survive the darkest months of the crisis. And then there's CDPQ, the giant from Quebec. With roots going back to the 1960s, CDPQ has grown into a global powerhouse with a special focus on infrastructure. Airports in Europe, wind farms in North America, real estate in Asia, you'll find CDPQ money in all of them. During crises, CDPQ has often been the quiet rescuer, providing capital when other investors flee. For example, during the European debt crisis, CDPQ bought stakes in Spanish toll roads that were collapsing under debt. Years later, as Europe recovered, those roads became profitable again, delivering strong returns. What's fascinating is that most people don't know any of this. Ask an average Canadian what CPPIB or OTPP is doing with their money, and they might shrug. They know they're contributing to a pension, but they don't realize that their retirement savings are being used to buy airports in France, office towers in London, or data centers in California. And they almost never hear that during global crises, their pension funds have stepped in to rescue companies on the brink. In a way, it's like Canada has built a network of financial superheroes, but the superheroes are accountants, investment managers, and portfolio analysts, quietly doing their jobs in Toronto, Montreal, and Ottawa. But of course, no story is this simple. While Canadian pension funds have done incredible things, they also face big risks and tough questions. For one, their size makes them powerful, maybe too powerful. When a fund like CPPIB moves billions into an industry, it can reshape entire markets. Some critics worry that these funds are too focused on global investments and not investing enough at home in Canada. Others argue that their secrecy makes it hard to hold them accountable. After all, when you control hundreds of billions of dollars, every decision has consequences. Should Canadians have more say in where that money goes? Should there be stricter rules on transparency? And then there's the question of morality. Pension funds are designed to maximize returns, but sometimes that means investing in controversial industries. Oil and gas, tobacco, mining, or companies accused of human rights violations. Canadian funds have faced criticism for some of these choices. During crises, when they swoop in to rescue companies, are they really saving jobs and stabilizing markets? Or are they just chasing bargains to boost returns? The answer is complicated, and it's part of what makes this story so fascinating. Still, the bigger picture is hard to ignore. Time and again, Canadian pension funds have acted when others hesitated. They've provided capital when markets froze. They've rescued companies that might have gone under. And they've done it not out of charity, but because their long-term horizon allows them to see beyond the panic. In doing so, they've not only protected Canadian retirees, but also played a quiet, stabilizing role in the global economy. And this is just the first layer of the story. In the next part, we'll dig deeper into the behind-the-scenes rescues, case studies of specific companies saved by Canadian pension money, the strategies used during different crises, and how these funds became known as the world's silent giants. Because if you really want to understand how Canada influences the global economy, you can't ignore the power of its pension funds.